Hey guys, the Bank of England just raised the base rate of interest by 0.5% to 4%. This is the 10th consecutive increase of the base rate since December 2021. To put the rate rise into perspective, the last time we had a base rate as high as 4% was around November 2008. This rate rise mirrors what the ECB did today also by raising their rate by 0.5%. However, it's a departure from the Federal Reserve in America, who increased their rates by 0.25%. Today I want to unpack what this means for our personal finances. What does it mean for your mortgage, your debt, your other debts like your credit cards? What does it mean for your savings, your investments? What does it mean for first-time buyers who are trying to get onto the property ladder? I want to unpack those one after the other. Now, I've just gone and read the detailed monetary policy committee meetings, their minutes of meetings, and it's always very telling when you look at those minutes of meetings who voted for what. There are 9 people who are charged with making those votes, to make those decisions on what way interest rates go. And looking at my notes here, 7 out of those 9 people voted for a 0.5% increase to 4%. 2 people decided to keep the rates fixed. Or rather not move the rates up, because their thinking was that the rate rise last time, which we've all been feeling in our rising costs and so on, they felt that that was already having an impact in bringing down inflation. And it will be very interesting to see how this then feeds into future decisions that the Bank of England are expected to make as 2023 unfolds. Okay, so looking at the inflation, let's look at the updates on inflation first. Inflation stood at around 10.5% in December. And looking at that, from what they've said, wholesale prices have fallen recently, as well as global supply chain disruptions appear to have reduced. Okay, so as a result of that, global demand has slowed down. So the Bank of England are forecasting that high rate, that double-digit inflation rate of 10.5% will fall sharply to around 4% towards the end of this year. I mean, that would be amazing if it actually happened. That's their forecast, okay? They're also forecasting that this will result in a shallower decline in GDP. So we're not going to feel, like a massive recession or anything like that, okay? Now, it's worth noting that although they're expecting CPI inflation, consumer price inflation, to fall sharply to around 4% later in the year, it's worth noting that that doesn't mean that our costs are suddenly falling as a result of it. It simply means that the sharpness to which the inflation rate has been rising will no longer be as sharp. It will be rising a lot slower. So our prices will actually still remain high. We're still going to be feeling it in our pockets, but the inflation rate is expected to fall, which is good news. Okay, let's look at the interest rates as an update, the interest rate update and forecast. The Bank of England are forecasting that the base rate will rise to 4.5% by the middle of 2023. Okay, so another 0.5% increase is expected in total between now and the middle of the year. They're then expecting that to fall back down to around 3.25% or just over 3.25%, they've said, in around 3 years' time. So that gives us a bit of an indication as to what they expect will happen. But bear in mind, this is pinned on the fact that they expect inflation to fall sharply. And as we know, this medium-term outlook they've got remains fairly uncertain. Okay, let's now look at the impact of this rate rise on mortgages. If you are currently on a tracker mortgage, for example, you will see an instant hit from this bank rate increase, i.e. you see your mortgage rates, your mortgage payments increase as a result of that. It's been estimated, looking at some numbers, that a rise from 3.5% to 4.5% will lead to a typical tracker mortgage rising by around £49 a month. And a standard variable mortgage, again linked to the bank rates, the base rate, will be increasing by around £31 on a monthly basis. For those on that standard variable rate, which is the rate that you typically get onto as soon as you come out of a fixed rate, you will naturally see your rate increase if the lender decides to feed that increase from the Bank of England onto you. Recent data by Money Facts has shown that the average standard variable rate is currently around 6.64%, which means if they pass on that 0.5% increase, you see your standard variable rate, hitting 7% and exceeding 7%. So if you're currently on that standard variable rate, you want to really think very carefully as to whether you want to remain on that SVR rate, or if you want to consider fixing a rate right now, or maybe waiting to see if rates are expected to fall further. Okay. If you're currently on a fixed rate, around 75% of households in the UK are currently on a fixed rate right now, and they're not expecting to see any changes to, you will not expect to see any changes to your payments on a monthly basis. However, if you are coming off that fixed rate, of which there are around 1.4 million people expected to be affected by this, you will expect to see a sharp increase in your payments on a monthly basis. Looking at fixed rates at the moment, the 2-year fixed rate is around 5.44% on average right now, and the 5-year fixed rate is hovering at around 5.2%. Looking at that 2-year fixed rate at 5.44%, interesting, we compare it to, say, around November 2021, you notice, and we've been talking about this for ages on this channel, you notice the huge change, because around that time, the average fixed rate was around 2.29. So it's been a massive departure in that fixed rate, obviously, compared to what we're seeing right now. I'm just looking at the markets for you guys at the moment. I'm looking at the Money Facts website. For those of you who are looking for the best remortgage rates, the best 2-year remortgage rates at the moment, it's around 4.35%, assuming a maximum loan to value of 60%. For those who are looking for a 5-year fixed deal, it's around 4.13% for the best deals right now for remortgages, assuming a maximum of 60% loan to value again. Okay. For those moving home, it's around the same again, 4.35%, but for 5-year fixed, it's around 4.17%. Again, I'll link to this below. You can go and check this out for yourself. And now, shifting gears to first-time buyers. Actually, before I do that, I wanted to just say, for those of you who are on fixed rates and expecting your fixed rates to end at some point this year, and expecting a sharp rise in your mortgage payments, our recommendation here, or our suggestion rather, is that you should focus very strictly on your budgeting as a household, and actually consider overpaying on your mortgage if your budget allows it. The goal of doing this, the advantage of doing this, is that it helps it increase, to improve your loan to value, which then means that you're more likely to have better rates available to you when you come to have that remortgage done. Now, shifting gears to first-time buyers, as many people who watch our channel here are first-time buyers and aspiring to get onto that property ladder, it's clear that the mortgage rates are getting better. It would appear that the worst is behind us from a rates perspective, and last autumn, we would have seen some of the highest rates for people like yourselves getting onto the property ladder for the first time. However, you still need to put down a fairly significant deposit, in my opinion, if you want to get some of the best rates right now, and obviously seek an independent mortgage broker for some advice. Now, looking here again at the website I mentioned earlier, for first-time buyer rates right now, for 2-year fixed, assuming a maximum 90% loan to value, I'm seeing rates at around 4.82%. It's some of the best rates at the moment. And for a 5-year fixed, again, a maximum 90% loan to value rate, I'm seeing rates of around 4.58%, okay, which are high rates. They're pretty high rates for first-time buyers, but again, you know, they're not as crazy as they've been in the last few months. For those of you who are interested in buy-to-lets, you know, who are still trying to make the numbers work for you from a buy-to-let perspective, again, a 2-year fix, I'm seeing at around 3.99%, which is interesting, but it requires a maximum loan to value of 65%, and a 5-year fixed at around 4.34%, again requiring a loan to value of around 65%. So that requires people to put down more than the traditional 25% if they wanted to, you know, potentially get into a buy-to-let situation. Let's talk debts right now. Now, the key thing to mention when it comes to debt is that anyone with an existing fixed rate, say personal loan or car loan or anything like that, will not see any changes happen to their payments as a result of these announcements today. Okay. Looking at credit cards, you know, now credit cards are not, though they're not typically pegged to the base rate changing, it's worth noting that, you know, your credit cards and your overdrafts could actually still go up if your lender chooses to actually pass on the base rate increase onto you as a borrower. Okay. However, it's worth noting that for credit cards specifically, you will definitely be given notice by your lender if that was to happen. But if you're my suggestion right now, if you've got quite big significant credit card debts, which we've seen as a rising trend given the current cost of living crisis over the last few months and over the last, say, 12 months, for example, there's been that steady rise in the reliance on debt. So what you might want to consider is signing up to a 0% balance transfer credit card as a way to try to manage that credit card situation and reduce the impact of interest rates, of interest payments that you have to make with your credit cards. Now, with bigger loans, let's say you've got bigger loans, or let's say you've got multiple debts and so on, one consideration might be that you might want to consider consolidating your debts. That might be your way of getting a better arrangement from a debt perspective. But do definitely make sure you seek some advice when doing this sort of stuff, and even consider getting advice from a debt counselor as a way of making sure that you're making the best decisions for your personal circumstances. Now, looking at savings, obviously naturally with interest rates rising, you expect this to be really good news for savers. However, not all the banks are passing on those savings on to diligent savers. You can get a decent easy access savings rate for around, say, 3%, and a bit better for a fixed rate account, and even better for a regular saver. So do definitely make sure you're checking them out. But the key thing to mention, and I have mentioned this previously, and although it sounds obvious, but it's worth mentioning that the real return you're getting on your money when you put your money into a savings account, say, let's say your savings account is generating you 4% interest, making up, for example, if inflation is currently at around 10.5%, then the real return is a negative number, minus about 6.5% thereabouts. So the key thing is to really focus on the real return you're getting, but getting some returns better than getting nothing. Personally, if I was in your shoes, and this is what I'm doing personally, I'm making sure that I'm using my allowances for the likes of my stocks and shares ISA and maxing that out, because you'll remember with the changes that were made in the UK from a tax perspective last year, that the tax environment is going to get it's not going to be very pretty from the 6th of April. So you want to really make sure that you are using up all the allowances that are available to you. So for me, it's about trying to max out, your ISA allowances and making sure you're getting your money into an environment where you are obviously legally, according to the allowances that are available to all of us, you are using those allowances as tax efficiently as possible. I've actually made a video on this, I'll link to it below and above, just talking about taxes and that sort of stuff, and using ISAs, pensions and so on much more tax efficiently. Now, looking at investments, stock markets tend to price in these decisions made by central banks and so on. So, it's widely expected. It's already the change today was already widely expected from an investment perspective. However, our focus and what we're doing personally is focusing on, very international companies from an investment perspective, thinking very globally, as well as leaving our money exposed to dividend-paying companies that pay us fairly good, fairly decent dividends. So I'd say more generally, our strategy is still a passive focus, global focus, whilst keeping our costs from an investing perspective as cheap as possible. Remember what I said before about maxing out your allowances, because as from the 6th of April, things just change more generally from a UK perspective, from a tax perspective. So it's definitely worth bearing that in mind. Overall, I'd say that it would appear that the future direction from an interest rate perspective is that we will expect some increases, as the Bank of England have given us some guidance, but given that they're expecting inflation to drop quite sharply, again, a big warning with that, because there's a great deal of uncertainty. It's expected is the key word there, that we've seen some of the words from a rate rise perspective behind us. It's unlikely that we will see rate rises that are higher than what we are seeing right now, all things being equal. Okay, it's definitely worth bearing in mind. More generally, because I know a lot of people, a lot of families, a lot of individuals are struggling financially, I'd say a big focus will be on making sure, and I said this in December, making sure that you are paying very close attention to your budgeting from a family perspective or from a household perspective, and that you're really making sure that you're building a decent enough cushion given what's expected, the uncertainties in this year of 2023. Again, as it's true to our channel, I'd highly recommend making sure that you're going above and beyond from using your skills and your abilities to explore alternative ways that you can make some extra money to either amplify some of your savings or help you towards investing more and growing your wealth in this season. Stay on top of your work more naturally. This is what I would be doing, just making sure that I'm bringing my best to the office and doing the best that I can, and just making sure that overall, I'd say just look after yourself more generally. Don't think too much about these rate rises from a negative perspective, even though I know it's hitting your pocket and it's hitting many people's pockets, hitting all our pockets. Try not to let the worry about it and the related negativity around these rate rises actually affect your mental health and your mental well-being. So do try and protect yourself and look after yourself more generally. Okay. The next date to be aware of from a rate rise perspective is the 23rd of March 2023. So that's when next we're expecting these rate rises to be announced again. And I'll be doing another update when that happens. Overall, stay positive and stay practical more generally. All right. Much love. Feel free to drop me a comment below for Mary and I. And if you've got any questions on the back of what I've shared today, we'll be more than happy to jump in the comments and get back to you. All right, guys, as always, in all things, be thankful and seek joy. Take care.